the United States Federal Reserve continues to raise interest rates at an alarming rate in order to try and keep raging inflation at bay. Many believe that Fed Chairman Jerome Powell took too long to begin raising rates when inflation first began, citing that it was transitory at the time and basically would dissipate on its own. The economy has certainly experienced a multitude of extreme events over the last few years, which has indeed disrupted supply chains, the workforce, fuel prices, and people's behavior and financial condition. If the root cause of some of these issues could be remedied, it would perhaps have mitigated some rising costs contributing to this massive inflation. However, the Fed aggressively began tightening in March of this year, multiplying the Fed funds rate by an astounding 18-fold since then. This rapid increase has already caused consumer prices to see reversal in some cases, such as with oil coming back down from the 120s to the 70s, and the Baltic Dry Index, which measures dry bulk shipping and transportation prices, down about 75% from the highs and back to 2020 levels. But the Fed continues to raise rates even after signs of a reduction in inflation to truly guarantee that price increases don't bounce back. Now, Elon Musk, whose companies, specifically Tesla, purchases vast amounts of raw materials, said back in November that the trend from the Fed was concerning. He recommended that the Fed needs to cut interest rates immediately, stating that they are massively amplifying the probability of a severe recession. And then later in December, he warned that if the Fed raises rates again in December, which they ended up doing, it would greatly amplify the recession. And one of the reasons why Elon Musk is saying this is because according to him, the data he's seeing shows that we're already in deflation. And so persistent increases could have large repercussions on the economy. Specifically, rising rates appear to already be having significantly adverse effects in the automotive financing market. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Rising interest rates may already be affecting consumer behavior when it comes to auto loans. According to Twitter user Car Dealership Guy, he notes something interesting and yet very alarming that's happening in the auto lending market, something that both Elon Musk and Cathie Wood from ARK Invest have echoed. Over the past few years, people have been taking out exorbitant loans on cars, especially given that because we've seen supply chain issues and therefore a scarcity of vehicles, be it electric or internal combustion engine, the prices have all gone up dramatically on both new and used cars. People have had a difficult time getting their ordered vehicle delivered in a short time span, and so they're willing to pay more to get one today. And in addition, raw costs and transportation costs have been sent higher, causing inflation along the value chain, and car makers have raised prices due to the high demand driven by low supply. And this is still the case for much of the industry at the current time. It could still take months, if not years in some cases, to get a new gas, hybrid, plug-in hybrid, and even electric vehicle. Now, many people simply had no choice but to buy an overpriced car. And this makes a lot of sense, since a vehicle is a necessity for many, especially if they need to get to work or simply commute for their daily responsibilities. Additionally, the average age of a car in the US is about 12 years old, and so every year there's constant demand for new cars as the global fleet gets refreshed slowly over time. Now, according to Car Dealership Guy, car valuations are now plummeting, some as much as 30% over the previous year, and he says that now these car owners owe the banks more than the vehicles are worth. Now, the buyers of these cars are likely not monitoring their car values daily to see if they've depreciated. Usually once a car is purchased, people no longer need to continue researching their car, so they're probably not paying attention to the price. However, that's not where the concern lies. In these cases, perhaps they purchased a vehicle that keeps breaking, or they outgrew it, as the tweet suggests, or they simply no longer want the car and want to trade it in for a different one. This makes sense because due to the scarcity of vehicles, anyone could have overpaid for a car they didn't truly want. And so now they go to trade it in, and the value has dropped tremendously. So the dealer isn't paying for it what they would have even just a few months ago. Therefore, the dealer needs the consumer to put up the difference in value lost. But the consumer typically doesn't have the money lying around to do that. And so they get into the situation where the dealership can't sell them the new car because the trade-in doesn't make it worthwhile. And the lender won't lend out a new car loan because they already have this outstanding loan from a different bank. And so the crazy thing that car dealership guy witnessed is that the lender will waive the open auto stipulation, meaning that they will still allow the customer to go through with buying the new car and give them the new loan, knowing that they have a separate outstanding loan on a different car. And they do this even though this new loan is technically a lot riskier. And so he says that the reason why they do it is because they need to finance more deals to keep putting more cars on the road. And so they make a calculated guess that the customer will default on the other loan on the car that they don't want, which will lead to tons of repossessions. And it seems that in this case, when the lender gives out the second loan, they're not actually doing the trade-in because the trade-in car will be repossessed. So they would give the loan on the full value of the new car without any trade-in. Now, Elon Musk replied to this thread saying, "Good prediction." And so if this turns out to be true at a large scale, it will have way more implications than just the repossession of many cars. It could further snowball the decline in vehicle prices, because now more supply is coming onto the road, but the bank needs to try and get rid of the repossessed cars at any price in order to recoup their losses. So there could be a flood of lower cost inventory down the road, which could lead to further auto value declines, making this situation more likely to occur even more frequently. Also, the banks are backstabbing each other in this scenario, and maybe even themselves, because the original lender is left with a repossessed lowered value car, but the new lender may be screwing themselves too, since the customer used their original down payment and perhaps even their original trade-in vehicle in order to get the first car that they had. But with this second loan, they may not have either of these, certainly not the trade-in. Furthermore, the original loan was likely locked in for a number of years at a decent interest rate, but now the interest rates have all gone up. So even if the values of cars have all gone down, the payment on the new loan may be offset by these factors and could be just as high if not much higher, leading to a high risk of default in the future on this new second loan as well. Kathy Wood of investment firm ARK Invest replied to the thread saying that they too have been concerned about the declining residual values of cars represented in the $1 trillion+ auto loan market. She says most of these loans back gas-powered vehicles, which makes sense since they are by far the majority of vehicles sold in general. She also believes that the crisis is underway. Now, Kathy Wood says that the consumer preference shift towards electric vehicles will exacerbate this crisis. And Elon Musk replies to this, saying that it's potentially the biggest financial crisis ever. Now, this may affect the entire industry, independent of what type of vehicle model or fuel type, be it hybrid or gas or electric, was purchased. But Kathy Wood specifically says that the consumer preference shift to EVs could exacerbate this crisis. Now, she's not referring to this trade-in repossession scenario becoming more frequent because people are trading in their gas cars for EVs, although that could be happening. But rather, it's more likely that as the electric vehicle market expands rapidly, people are generally switching to EVs, which could lead to higher gas car inventory and thus lower gas car prices, which indeed could exacerbate the aforementioned issue. Now, it seems like the lenders here would be the ones most at risk if this financial crisis in the automotive loan sector were to play out at scale. The banks are the ones taking on the risk of the loan, and would be stuck with a low-valued car that they would need to liquidate. Now, in Tesla's case, the financing loans that it provides for its buyers who select the finance option are from third-party banks that work with Tesla, but it's the banks who are again taking on this risk. If we look at Tesla's balance sheet, they have very little debt, having paid it off over the last few years. But the important thing is that Tesla doesn't do its own vehicle financing, which is where the real risk is at, given the aforementioned scenario. Now, Tesla does have about $3.5 billion, mostly related to vehicle leases, which is a high-margin business where they expect to get the vehicle back within, say, 3 to 4 years when the lease ends. Tesla seems to want all of these vehicles back, perhaps for the robotaxi business, and doesn't give the customer a chance to buy out the remaining value on the car. But if residual values drop low enough and fast enough, it could increase used car inventories, and not just for Tesla, but for all automakers. In Tesla's case, if anything were to go wrong here, even the entire amount is very manageable given Tesla's roughly $20 billion cash position, and leasing is still fairly low risk. But most other automakers are masquerading as banks, and these finance divisions do very well for their parent companies at least until some crisis event occurs. If we look back to the 2008 financial crisis, General Motors' financial arm was called GMAC, one of the largest car financing companies in the US, which today has been spun off and separated as the company known as Ally. But back then, the government had to bail out GMAC with at least $6 billion, as the company was critical to the survival of General Motors, and basically helped drag it down into bankruptcy. GM has since replaced its financial arm with a new one called GM Financial, which has accrued tens of billions of dollars of loans as seen on GM's financial statements. As of the most recent quarter, GM Financial had over $62 billion just from retail financing alone, not to mention other types of financing or leasing. Ford has a similar setup with Ford Credit, which adds over $115 billion to Ford's liabilities, with $67 billion related to consumer financing. And we see this similar setup at Volkswagen and Toyota and others. It's also interesting to note that the majority of the financing is typically for the respective company's own vehicles. So hypothetically, if everyone wants to trade in their Ford vehicles, for example, for whatever reason, it's a double whammy as it hurts both Ford's sales and its financial arm. On Twitter, Farzad Misbahi said that everyone is focusing on Tesla, but the other automakers are on the doorstep of bankruptcy. And Elon Musk replied saying, much closer than they realize. It doesn't take relatively all that much, as we saw during the 2008 financial crisis, to bankrupt all of the automakers, and that's in part due to their financial arms, which suffer greatly and drag down the company at times of crisis. And going back to Cathie Woods' point from earlier, there's already a massive shift to EVs occurring where most automakers are far behind Tesla, and they will need to cut back on their non-profitable EVs, while Tesla is positioned quite well to grow even during a time of financial hardship. On top of this, just recently, Tesla cut through supply chain issues, making the lead times for their vehicles just a few weeks compared to the 6 months to a year that they were previously. Everyone is attributing this to weakening demand, but if the upcoming $7,500 tax credit spurs demand as it's meant to, only Tesla will be able to deliver vehicles right away, which could lead to canceled orders at other OEMs that have a 6-month backlog due to supply constraints. So there are a number of factors that could come together in a perfect storm to truly intensify the calamity in the automotive playing field. The Fed's rapid interest rate increases already appears to be having adverse effects in the vehicle lending space, which could put the over $1 trillion auto financing market at risk. So do you think a prolonged financial crisis or recession could cause automakers to start going bankrupt, just as we saw in 2008? Which automakers do you believe are best positioned to weather a financial storm, and which are the worst? Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.